Welcome back to your weekly market outlook. This is for the 10th of June 2024. So let's get started with a quick recap of what's been going on last week. I think the main focus there was we have the Bank of Canada and then we have the ECB both cutting interest rates by 25 basis points. That goes to show that the whole world is probably not waiting for the FOMC in terms of rate cuts. Now, if we take a look at the number that kind of came out at the very end of last week, which is the labor data from the US, this was a little bit of a mixed data, but market reaction to that, it's really more of a surprise to the upside at this point in time. The NFP numbers there, last month's NFP number was actually revised down from 175,000 to 165,000. And we have a number that beats the expectation of 182,000. We got 272,000, which is a significant gain in terms of the NFP number. On top of that, we have the average hourly earnings also growing by 0.4%, which is kind of above what market is expecting at 0.3% growth. But the unemployment rate does pick up with it as well. So the unemployment rate is now at 4%. No revision to the previous unemployment rate. It was at 3.9%. We now have 4% inflation rate. So 4% unemployment rate. Now this is actually a very mixed data here. Despite the NFP number there, we had a short-term reaction in the market in terms of the NFP gains from last week. But at the end of the day, unemployment rate does pick up and it's now at 4%. Now this is a concern considering the 4% number here. That could actually pose a little bit of a threat for the FOMC to kind of expedite their interest rate cut. Now, in terms of interest rate cuts coming up from the FOMC, obviously we still need to wait for the inflation number, which is going to be released this week. That's going to be on Wednesday. But judging by what we have here, I think the FOMC needs to move quickly. They probably wouldn't wait until the end of the year, especially if the unemployment rate continues to pick up above 4%, because that's going to put the whole labor market into a dangerous position. Now, the expectation for the inflation number here, if we take a look at the yearly inflation number, this is expected to be flat at 3.4%. Now, early reports are starting to come in right now, and there are changes to the potential forecast here. The expectation here is that the inflation could actually be hotter than expected. So we might actually get a little bit more of an uptick to the upside. Now, considering the monthly growth rate here, the expectation is for a 0.1% growth. We might actually get a number that's actually slightly above 0.1% growth. Now, this is basically what the market is expecting in terms of whether or not inflation could actually be a little bit more on the hot side there. Inflation could actually still heat up. We might not see inflation go down. It might stay flat at 3.4%. It might actually pick up to 3.5% from early forecasts here. Monthly growth here is expected to drop down from 0.3% to 0.1%. We might actually get a number that's probably closer to 0.3% growth, where there's no change in terms of the monthly growth. The core CPI growth expected to remain the same at 0.3%. Now, other news for this week, we have the UK unemployment rate. We also have the UK claimant count change. That's going to be on Tuesday. And also on Wednesday, we are going to get our UK GDP numbers. Other than that, we also have the FOMC interest rate decision. Now, this interest rate decision would come in pretty much on the same day as the CPI release. Again, not expecting any surprises here, not expecting the FOMC to cut by 25 basis points, at least not in this meeting. I think the market is kind of expecting for a rate cut to happen in the month of September, not in the month of June. So no surprises coming out from the FOMC. But again, I think there's going to be a discussion in terms of the higher than expected unemployment rate and also the most recent number for inflation that's going to be brought up during the FOMC press conference as well. So just keep that in mind. I think we are here for a pretty jam-packed week. Now, other than that, we have the Australian labor numbers, their unemployment rate is expected to drop down slightly from 4.1% to 4%. And we have the PPI that's going to be released on Thursday. On Friday, Bank of Japan is expected to announce their monetary policy. No expected changes here. Not expecting a rate hike from the Bank of Japan. We're not expecting any major changes in terms of their monetary policy there. Regardless, I think this could still have an impact if you're trading the Japanese yen cross. Again, this week is going to be a very jam-packed week. Obviously, we have the FOMC and the Bank of Japan interest rate decision. Not expecting changes. We're watching out for any changes in the language that they've used. We're also looking at the American CPI number, or the US inflation number here, which is going to be released on Wednesday. Now let's move on to the technicals here. This is for the Aussie USD. We have found that rejection at 67 cents last week on Friday. It closes below 66 cents. So right now we do have an immediate resistance at 66 cents, and for as long as price is actually still trading below the pivot level for this week, which is going to be at 66.25, there are still going to be potential move lower for the Aussie USD, but we're not expecting a drop below 65 cents. Again, as I always say, the Aussie USD remains a relatively stable currency. We're looking at 65 cents to 67 cents as a range. 66 cents is kind of the midway point there for the Aussie USD. So for now, if we have that rejection at 66 cents, we might see a little bit of a deeper correction back towards the Ichimoku cloud. That's going to be closer to the support one range, which is about 65.50 on the Aussie USD. Now Euro USD, we found that rejection at 1.09, and again we always mention, look, it's going to be really tough for the euro to actually gain if it didn't break above 1.09. Now last week's price movement, obviously we have that rate cut coming up from the ECB. Comments coming up from the ECB sounds a little bit more on the dovish side as well. They're not being hawkish at all, and then the final push comes with the better than expected NFP numbers. So we have that push lower below 1.08, and that saw the market gaps down on Monday today, and we have an early price movement here. Obviously we still need to fill in that gap. We're not completely bearish yet on the Euro USD. This one here is still within the boundaries of a healthy correction. There's still inside the Ichimoku cloud. As long as price is not trading below 1.07, we're not expecting a potential reversal on the Euro USD. In fact, if we take a look at this one here, where current price level is currently located, which is pretty much at 1.0750, all the way down to support 2 for the weekly at 1.0725, we might actually see a potential for Euro USD to bounce back and retest 1.08 one more time. Now that retest towards 1.08 is obviously important, because any rejection from 1.08 is likely going to put the Euro USD more in a bearish tone. But until that happens, until we see that retest at around 1.08, it's too early to tell if there's going to be a reversal on the Euro USD. Now this is in turn supported by the movement on the pound USD. We saw what happened with the pound USD there. We saw that rejection at 1.28. However, pound USD was never below 1.27, and this is definitely still a concern, because if we take a look at it from a technical perspective, a healthy correction is actually one that moves towards 1.26. Now we're still not below 1.27, even with the Friday's close, even with the Monday's gap on the Euro USD. Price for the pound USD still remains above 1.27. We do anticipate a potential dip lower below 1.27. If that's the case, then we're anticipating support 1 and support 2 to be a relatively strong support for the pound USD. This is still also going to be above the Ichimoku cloud. For as long as price is still trading above 1.26, we're not going to call a reversal on the pound USD. In fact, we're still going to treat this as a healthy correction where we anticipate potential bounces to happen on the pound USD. Now, obviously, the key resistance here is going to be 1.28. Therefore, if price does not go above 1.28, then we're not going to be looking at any uptrend here on the pound USD. So this one here, I would consider this to be more of a within a technical correction range. We're anticipating 1.27 right now as an immediate support, and a push lower below 1.27 we're anticipating a potential buy on the dip scenario by a lot of market traders here. Obviously, the UK employment numbers is going to be a big factor for the pound USD as well. The GDP is also going to play a very important factor as well. And we do know that in the UK, elections coming up soon. July 4th is going to be their general election. So I think there's still going to be a little bit of a concern in terms of where the political direction is going to be. That could impact the sterling. But from a technical perspective, I think this is still a healthy move for the pound USD, and we actually prefer a much deeper correction here. We actually want to see a move closer towards 1.26. We're not expecting buyers to come in until price is actually closer to around 1.26. Okay, right, next up we have the Dow Japanese Yen. Now with the Dow Japanese Yen, we talk about a potential bounce from the Ishimoku cloud. We're looking at 154.50 as and 155 as kind of a stronger support for the Dow Japanese Yen. That basically still plays out as per our outlook there. We saw that bounce from 154.50. Obviously, we saw a little bit of a carry trade unwinding. Now this carry trade unwinding was actually triggered by a sell-off in the Mexican peso. Obviously, we saw that unwinding affects the Dow Yen, the Euro Yen, the Sterling Yen, but you can take a look at the demand in the market here. Everyone's still into that carry trades here. The interest rate differentials between the Bank of Japan and the FOMC is still so far apart that, you know, any drop, any dip to the downside, we're going to get demand at the lower range there. We're going to be anticipating buyers to come in and pick this up again, and that's basically what we saw. We saw price picked up from 154.50, 155, and right now price is barely trading above 157. But in terms of how far the Dow Japanese Yen can go, the Dow Japanese Yen, we're likely going to find resistance very close now at around 157.50. Beyond that, we're looking at 158. But you know, this is probably going to be a creep up back to 160. Again, we do not anticipate any further intervention from the Ministry of Finance as well as the Bank of Japan as well. In this case, in terms of the volatility, in terms of how strong the dollar against the Japanese yen, this is still pretty much in a controlled environment. All right, finally we have gold. And this is something that we need to talk about. So gold on Friday, we have a huge sell-off on Friday. Now this is on the back of the PBOC, which is the Chinese central bank. They're reporting that they did not purchase any gold reserve in the month of May. Now this is actually the first time since 2022, the first time in 18 months that the Chinese central bank does not buy any gold reserve. Now this is, you know, quite an indication to what's going on in the market. We have identified the potential run for an all-time high on gold that previously partly was affected by how central banks was actually buying gold as a reserve. Now this is the first time that we saw China not buying, and that would be an early indication that demand for gold could actually falter a little bit. Now the other thing is obviously the higher than expected NFP numbers. That would actually pose a potential risk to the market, where, you know, labor market is strong and, you know, we're expecting a higher inflation number to come in. So the market is probably not expecting a rate cut from the FOMC this month, and that does have a little bit of a bearish sentiment into gold as well. Now overall, we still think gold, it's still well supported. Right now we have a very critical support level there, which is the low point at 2275. Right now price is already trading below 2300, so we have broken below that support at 2300 here. The next one is going to be 2275. Now with 2275, there are several criteria to think about on this one here. Number one, we would actually look at this as a potential neckline for gold there. If it breaks below 2275, there could be a potential where it would confirm a potential head and shoulder formation in gold. If price breaks below 2275 and maintain a position below 2275 for the next week or so, we might transition back below the Ishimoku cloud. But, you know, considering all this, we stick to how we view gold here, is that this is very well supported. We have support 1 and support 2 going all the way down to 220 here, and obviously the key level is still going to be 2200. We have a very thick Ishimoku cloud here, but we're not ruling out any possibilities that gold could slide further if all the central banks are reporting that they're not buying any gold reserve. This is probably going to be a delayed effect, but obviously this is going to be a lot of consideration to gold traders that why is China not buying gold reserve? Is there a particular reason why they're not doing that, considering that gold is not at a very high price in terms of the all-time high? It's actually about 2,400-ish. And in terms of the month of May, we actually saw gold prices pull back down below 2,350. And why isn't the Chinese central bank not buying gold reserve at a price that's actually cheaper than around 2,400? So this would be the consideration going forward as well. This is going to be one factor that's going to impact gold prices going forward. Now, again, as I say, the key level here is we need to watch out for 2,275. If we break below 2,275, then there's actually going to be a high probability that the gold run or the gold rally could be ending. That would be the first indication of a potential sell-off in gold. So again, 2275 is going to be a very important price level to watch out for. On the flip side, if price manages to climb back up above 2,350, that would actually confirm the support around the Ichimoku cloud. That would actually potentially take gold prices even higher as well. So I would assume from the current price movement and how market is reacting to dollar strength, the inflation number and the FOMC rate decision is going to be the key factor for this week. All right, so with that, good luck to your trades, and I'll see you soon.